Hi, we're back. Thanks for staying with us and joined in studio now by the Mortgage Minute guy, Roger Schlesinger. Roger, always great to see you.
Good to see you.
Now, something was kind of amiss there. They just put a kind of a picture across my face. What's going on?
Well, that's what I look like in January, but since Dodd-Frank came out, this is what I look like now.
Well, you know, I mean, that's been a nightmare for most people in your business, but I know that you always have good news about the mortgage industry. What's the good news you have for us this week?
Well, the good news is that I have discovered, or certainly looked into and found, that I can show you how you can go from a 30 to a 20, save money, and knock off 10 years of your payments.
Now, so many people are always concerned when they hear that because they're saying, well, gee, the only reason I can afford my mortgage is because it's at 30 years, but you don't agree.
No. If you're in your loan for, let's say, 5 years, and let's say your loan is like 4 7/8 on a 30-year, and you know now you probably can get one in the high 3s. Well, I took that, and then I also took the fact that you could go from a 30-year to a 20-year, which is closer to the middle 3s, just a little bit lower than a 30-year loan.
Mm-hmm.
I ran the 30-year loan, and you'll have tremendous savings. On, let's say, a $350,000 loan, you'll probably save $19,000 in the next 5 years in payments. But you're paying an awful price for it because you're giving away a lot of amortization because you're starting all over again.
Mm-hmm.
And so that's something that people never look at. I'm not worried about my amortization. Okay, then I ran a 20-year. And you're not going to save much money at all. In fact, in the example I did, you're actually going to pay $20 a month more than you're paying now. But the amortization is gigantic. So when I added up at the end of 5 years, on the 30-year you were saving $19,000 plus, and you got some amortization, and I added back the $20 a month that we're paying on the other one. And on the other one, we got a gigantic amortization. You actually were better off with the amortization on the 20-year than you were with the savings on payment and amortization on the 30-year. You were about $5,000 better off.
Wow.
Okay, but that's all right. But now look where you are. If you went from a 30 to a 30, you now have 25 years to pay. If you went from a 30 to a 20, you have 15 years to pay. 10 years of savings, and it's not costing you a penny. It's not costing you anything. How can you pass something like this up?
Well, it really comes down to whether you want a low payment or financial independence. A lot of people go into a situation of thinking only payment, 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 and really, as you've just demonstrated for us, you can knock 10 years off that payment and talk about financial independence.
Right. And not only that, if you're not going to do anything, and you just want to say, yeah, you know what, I'm happy here, I don't even want to refinance, or I have a little problem and I can't refinance, at least write a check every month to pay down your principal, because the way the mortgage industry is, it's simple interest. Mm-hmm. And so whatever your principal is, you pay that interest rate against it each and every month for the time that you have left on it. So at least write $5 or $500, because you're doing two things. You're paying down your loan, and you're also reducing your interest payment on a monthly basis.
If you want to pick Roger's brain for more of this information, and you really should, go to their website, mortgageminuteguy.com. Roger Schlesinger is the Mortgage Minute Guy. Roger, thanks so much.
Thank you, Don. Good to see you.